Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to the Bert Salazar Retirement Show. My name is Bert Salazar, and I'm going to be the host, as I am every single week for all of you. Today's episode is actually episode number 156, and the title for this episode is How can a 7702 contract become a supplemental retirement plan? You know, when it comes to retirement, I like to keep it simple because there's a lot of things happening in the marketplace today, not only from an inflationary standpoint, but also from a tax and revenue standpoint and debt when it comes to the U.S. and the U.S. government, that, you know, the simpler that you can keep your decision-making process when it comes to your retirement and your retirement success, the better off all of you are going to be, and all of us are going to be from that perspective. So what I'd like to do today is I want to talk to you about, which I have done before. I have done a podcast on this, I would say probably about a year ago. But what I want to do today, I want to give you a little bit more emphasis on existing products and services that are available to each and every one of us and each and every one of you today that can maximize your ability to retire comfortably in this volatile world that we live in. So I want to talk a little bit about a 7702 contract. And I think the big question for many of you is, what is a 7702 contract? Well, a 7702 plan is a plan under the IRS code. It's actually IRS code 7702. And it's primarily a life insurance contract that has tremendous features and tremendous flexibility when it comes to your planning for retirement. Its versatility actually makes it one of the best products to own in the financial world today, and I'll go into some details on that, but it's important for all of us to get to know what a 7702 plan is. Now, the features and benefits of a 7702 plan can be actually tailor-made for your specific goals and objectives. So I have over 250 clients, and most of the clients that I have in my portfolio have some kind of a 7702 plan, and not a single 7702 plan, if you do it the right way, looks the same. So you can have one person with a 7702 plan that is more suitable to their specific goals and objectives, and then you can have another person with a different one altogether, but it makes sense for them. So now that we've talked a little bit about a 7702 plan, which is nothing more and nothing less than a life insurance contract, then the next question is, you know, what are the features of a 7702 plan? What are some of the benefits, and why, you know, should I choose one over the other? So that's where the strategy of the advisor that works that you work with comes into play, because just about every financial advisor in the marketplace can do a 7702 plan. I think the challenge for all of you is to identify those financial advisors that are experts in the preparation and the detail of a suitable 7702 plan for you and for your family. So what are some of the features and benefits of a 7702 plan? I'm going to break it down into two parts. I'm going to break it into the insurance or death benefit side of a 7702 plan, and then I'll put it into the cash accumulation side of the same 7702 plan, and I'll put that on a different scale altogether. So scale number one, the features and benefits on the death side of the house of a 7702 plan is federal income tax-free death benefit. So that's a major issue, because if you own a 7702 plan, and you don't make it to tomorrow, and as you always hear me say, tomorrow is promised to no one. We just had a big building in Surfside, Florida, fall overnight, and over 150 people died. And when those individuals and those families, went to sleep that night, they did not think that they were not going to wake up the next morning, and none of them did. Now there were some survivors, but it was on the other side of the building that did not collapse. So when someone dies, that federal income tax benefit is a major benefit for the surviving family, for the surviving spouse, and the surviving children. Now, one of the features of the 7702 plan is that the death benefit can actually increase annually to offset inflation. So there are different ways. Some of them you don't have to get them to increase. Others, if you want to stay ahead of inflation, you can have the death benefit side increase every year. One of the things that I tell my clients is that the death benefit is like money in escrow, and escrow closes the day you die. So at the point in time that you pass away and your income stops, then the death benefit is going to come in and step in and become money in escrow, and is going to provide a tax-free benefit to your survivors. Now, one of the key features of the death benefit side of a 7702 plan is that death benefit riders provide for chronic and long-term care benefits at no additional cost. So it's acting as a living benefit rider. So you could say that you could use it on the cash value side, and I'll mention that on the cash value side as well. But it's also part of the death benefit because, the fatal four of retirement is what? I know that many of you have been listening to me now for a little over 3 years, and you always hear me talk about the fatal four in retirement. And the fatal four is, the risk of dying too soon, the risk of living too long, the risk of living with a disability, and then last but not least is the risk of living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, and several others along those lines. But when it comes to a 7702 plan, it actually can help you in each and every one of those areas of the fatal four. So in this case, having the death benefit not only act as a death benefit, but also as a way for you while you're alive to be able to go into that death benefit and pull money out in order to maintain your standard of living while you're going through a long-term care illness. That's a win-win, and that's very important. So you can actually add these riders for chronic and long-term care benefits at no additional cost, and that's a huge benefit, especially nowadays because of the cost of long-term care increasing at more than 7.5 to 8.5% on an annual basis. So that's going to be a major cost that all of us, or most of us, are going to have to deal with at some point in time in the future. So that's important. Now, it's the only financial product that covers the fatal four retirement, which is the one that I just walked you through. So it's the only financial product, and I hope you're hearing me correctly, it's the only financial product that covers the fatal four of retirement. Once again, the risk of dying too soon, living too long, living with a disability, or living with eroding factors. Now, both the death benefit and the cash value proceeds bypass probate. And one of the major reasons why it bypasses probate is that it has beneficiaries. You can have primary beneficiaries, and then you can have contingent beneficiaries as well. So one of the best features of that is that when someone dies, you don't have to go through probate in order to collect the benefits. You just need to file a death benefit claim form, and if you're a suitable beneficiary, then you will collect on that tax-free death benefit, and you will do that very, very quickly. Now, 7702 plans may be self-completing in case of death or disability. Now, there are certain riders inside 7702 plans that you're going to pay a little bit more for. But depending on what it is that you're trying to do for yourself and your family, the cost is well worth it to be able to pay for that. So for instance, if you become disabled and you can no longer make contributions to your 401k plans or your IRAs or your investment accounts, if you have a disability premium waiver rider or you have a disability rider inside of your 7702 plan, the insurance company will continue to make those payments into your plan so your money can continue to grow until the time that you finally retire. So those are some of the features that are so critical. Now, is it suitable for everyone? Not necessarily. If you're independently wealthy, it may not be an issue for you or your family. If you have a business and you're disabled and the business is doing well and it will continue to pay you disability benefits, and perhaps you don't need that rider. But for most of the clients that I deal with, a disability rider is a critical aspect of also being able to handle the issue of disability as well. Now, when it comes to the design of a 7702 plan, that's where the money's actually made. That is where the benefits are actually provided, and not every financial advisor is created equal. So for the most part, just to give you an idea, the insurance company determines the minimum contributions based on the amount of death benefit that you're going to purchase for the plan. The IRS is going to determine the maximum contribution that you can make into the plan. And then in the case of working with me, I determine, along with you, what the optimum contribution level should be. So just bear in mind that the insurance company will determine the minimum contribution, the IRS will determine the maximum contribution, and then we, you and I together, will determine the optimum contribution based on whatever it is that you're trying to do for yourself and your family. So those are tremendous death benefit features for 7702 plans, and there are many companies that you can purchase and acquire these plans from, and there are many different plans that are available. So not only do you need the ability to make the right decision at the right time and for the right reasons and under the right set of circumstances, but you also need to understand which company is going to be the best at doing this, and also which product is going to be the most suitable for you as well. Now, sometimes you have to do a combo, meaning a combination of different products in order to be able to accentuate the benefit of that plan for you and your family. So the next topic that I want to cover in the 7702 plan world is, what are the living benefits of a 7702 plan? So I already went through the death benefit and the features and benefits of the death side of the 7702 plan. So now I'm going to get into the living benefits of a 7702 plan, which is probably why all of you may be listening to this podcast today. Well, for some plans, and it depends on the type of product that you choose, there's contractually guaranteed cash value account. So every single year, your account is going to grow by a contractually guaranteed amount. No ifs and or buts about it. Cash account also increase annually on a tax deferred basis, which is one of the biggest features of the cash value side of the house on the living benefits, because the growth of that cash value grows on a tax deferred basis. Now, there's also guaranteed predictable growth that outperforms, traditional savings accounts and CDs. So when you have monies and deposits into your 7702 plans, you're getting guaranteed predictable growth. And many times it's going to be much, much better than if you had a savings account or a CD. The CDs are paying 0.0 nothing % today, so it's something to keep an eye out for. Now, some accounts pay additional tax-free dividends annually. Now, dividends in some of these accounts are not guaranteed, but the insurance companies that we use have been paying dividends every single year for at least 100 years. So although dividends are not guaranteed contractually, these insurance companies have been paying dividends for many, many years. So it's important to understand that as well. Now, another major feature of the living benefits of 7702 plans is that this no penalties for early withdrawals of cash values or cash accumulation, and there are no penalties for required minimum distribution. So as most of you know, if you have accounts where the money grows tax deferred, the IRS is going to place certain handcuffs on you. So one is the 59.5 rule. So if you have money's growing tax deferred, and you pull the money out prior to age 59.5 and 59.5, in most tax deferred accounts, you're going to have to pay taxes on the amount that you took out, plus you're going to have to pay a 10% penalty. Well, when it comes to accounts like Roth IRAs and Roth 401ks and 7702 plans and municipal bonds, you're not going to have to pay that 10% penalty, and you're not going to have to pay taxes on the account. Now, the other issue comes to the IRS issue comes to what they call the RMDs, which are required minimum distributions that are now today at age 72. So if you don't take money out of your retirement accounts, most of the accounts I'm talking about are traditional retirement accounts like IRAs and 401ks, traditional IRAs and 401ks. At age 72, you need to start taking required minimum distributions, because if you don't do so, then not only are you going to have to pay taxes on those distributions that you failed to take, but you're also going to have to pay a 50% excise tax on top of those distribution taxes that you didn't take before. So one of the things that you want to avoid for dear life is not taking a required minimum distribution at age 72, because otherwise you're going to pay dearly. Well, if you have a 7702 plan, you don't have to worry about the 59.5 rule, and you don't have to worry about the 72-year rule. So you have all the leverage. You have what I call the 3 C's. You have the care, custody, and control of your assets, because you and only you will determine when you're going to take money out of these accounts. So that's important to understand. Now, also in a 7702 plan, distributions are tax-free up to the cost basis, and then you can always switch to loans afterwards in order to avoid having to have a tax liability once you start getting into the growth portion of the account. Now, not other account in the financial world in the United States allows you to actually switch to a loan format in order to avoid the taxation of the growth inside of those accounts. So it's a great feature for all of you to understand, and all of you to be able to use at some point in time in the future. Now, if you really want to think about what a 7702 plan is, it's like a look-alike Roth account for the wealthy. You know, if you're making too much money, you're not going to be able to contribute to a Roth. So many of my clients are using 7702 plans as supplemental retirement plans in order to make large contributions to these plans and be able to maximize their internal rate of return and take money out on a tax-preferred basis. So also remember that 7702 plans allow you to put more money into those accounts than you could into anything else, whether it's a 401k, an IRA, and a Roth IRA, or a Roth 401k. So there are tremendous living benefit values that are very important to understand and very important to adhere to. Now, one of the major benefits that we have in Florida is that 7702 plans are creditor protected, and they're also creditor protected in many other states, but you need to check with your individual state to understand the protection that 7702 plans would be afforded to you if you happen to live in other states other than Florida. Another major benefit in this I dealt with for years is that cash value accounts are not reportable for school loans and grant qualifications for education and so forth. So it's one of the big features there. So you can have a lot of money inside a 7702 plan, and you don't have to report that for educational purposes if you have any type of college funding or you're using a 7702 plan as a college funding program. So I've given you quite a bit of information on the death benefit side of a 7702 plan and also on the living benefit. So think of a 7702 as a combo plan that can maximize your opportunity and can mean tremendous benefits to you and your family as well. Now, the next topic I want to cover with all of you goes now into the structure of a 7702 plan. Now, you notice that I told you in the very beginning of this podcast that the versatility of a 7702 plan makes it one of the best products to own in the financial world. Well, now I want to talk to you a little bit about how to apply that versatility to the structure of a 7702 plan. And here's where you're going to need the expertise of someone that do these types of plans on an annual basis, because there are a lot of moving parts inside of a 7702 plan. Now, the way that I have these plans designed, I design them in three different ways. Number one, I have a plan that is called the minimum maximum plan, which is the type of plan that I use as a supplemental retirement plan. It's a type of plan that I use if I want to maximize the internal rate of return on the cash account, on the growth of those accounts. If I want to use it as a supplemental retirement, if I wanted to use it for college funding purposes, if I wanted to use it for investment opportunities. So I'm going to do a minimum maximum plan. There, what I'm going to use is I'm going to do the minimum amount of death benefit possible that I can get away with in order to fund it with the maximum amount of contributions that will be earmarked primarily for the growth of the account and not necessarily for the growth of the death benefit. So a client that I engage in the minimum maximum plan really doesn't care that much about the death benefit other than to provide the tax shelter in order to grow those accounts on a tax deferred basis and then be able to pull the money out tax free. So for those types of clients, I'm going to do a minimum maximum plan. Then now there are clients that are mostly interested on the death benefit of a 7702 plan. So for those clients, I'm going to do the maximum minimum plan, which is the opposite of the minimum maximum. In the maximum minimum plan, what I'm looking for and what the client is looking for is the highest possible death benefit for the least amount of guaranteed premium that can be paid into that account. So regardless of when the client is going to die, the death benefit will be readily available to pay that tax-free death benefit in the future. Now, many of my clients do the maximum minimum to create legacies, to leave large amounts or large sums of money to beneficiaries on a tax-preferred basis. They use it for estate planning purposes. So there are many different uses that 7702 plans could be designed for. So that's important to understand. And then my third plan is what I call the leveraged combo plan, which is a combination of both. So I may have a client that comes to me and says, Bert, I do have the ability, I do like the idea of having a death benefit because, it can free up my decision-making process for some of my other assets to do other things with, perhaps even take a little bit more risk on my existing assets in my portfolio, because I know that the legacy for my family is going to be taken care of through the 7702 plan. But by the same token, I have maxed out my contributions to my IRAs and my 401ks and my Roth and so forth, and I still have quite a bit of money that I want to fund a 7702 plan for. So would I be able to create a plan where I can max out not only the death benefit but also the contributions that I can make into these plans? And the answer is yes. I put together then a leveraged combo plan based on the amount of monies that you're willing to fund your 7702 plan with. So, like I said, not all financial advisors in this marketplace are created equal. Not all 7702 plans are created equal. So it really determines, whether you want maximum flexibility, do you want a leverage plan, do you want maximum death benefit, do you want maximum cash value in order to address the specific issues that you may have. Now, then, the final point that I want to make here is, what can a 7702 plan be used for? Well, as I've said before, you can use it as a supplemental retirement plan. You can use it as a Social Security income replacement. So you see, most Americans don't think about that, because if you're a husband and wife and you're married, and both of you work for many years and you're now collecting Social Security benefits, when the first spouse passes away, the surviving spouse is either going to take the former spouse's Social Security benefit because it was higher, or he or she is going to keep their own because it was the higher one of the two. But nevertheless, when one of you passes on, then one of those Social Security benefits is going to go away. So a lot of the planning that I do for my retirees is how to protect the surviving spouse by creating a Social Security income replacement using a 7702 plan, so you can actually use it for that as well. You can use it for college funding. You can use it for wedding funding. I'm now going through a wedding, so my youngest daughter is getting married, so now I got to pay for a wedding, so that's something that I'm using my 7702 plan for. You can use it for a major home remodeling, so whatever it is that you may be doing, if you don't want to get a loan, or even if you want to get a loan but you want to offset it with a 7702 plan, you can do that as well. You can use a 7702 plan for emergency funds, so that way you have readily available dollars that are growing tax preferred for you and that are creditor protected. You can use it as an opportunities fund. Many of my clients use it to buy real estate, so they have a lot of money in their 7702 plans, and if a good piece of property comes along and they want to use it, then they use it right away, and they just take money out of their 7702 plan, and is readily available to purchase that piece of property. And although there are 30 different uses, I've just given you a few, and then the last one that I'll share with you is lending and lender opportunities. I do have a number of clients that are now semi-retirees, and they have quite a bit of dollars inside their 7702 plans, and they actually take money out of their 7702 plans and they lend it out at a much higher interest rate to people that have a need, and they do have properties that my clients can put a lien on in order to satisfy the protection of those loans and those monies that are being lent out. So that way, my clients are generating revenues inside of their 7702 plans, but they use one of those critical features in which they can take money out of the plan. The plan will continue to pay them interest on those monies that they took out, and then now they're able to leverage those monies by lending them out to individual borrowers at a much higher rate, sometimes 8, 9, 10, 12% interest rate that they're generating on an annual basis, and they're able to make quite a bit of money on the arbitrage between what they are charging their borrowers versus what the insurance company is charging them for that small loan that they're taking out of their 7702 plan. So there are many things that you can do with a properly structured 7702 plan. So, what are the next steps for you? I know that many of you may already have 7702 plans in place, but more than likely your advisors or the person that sold the 7702 plan actually never went through the proper explanation of the features and benefit of your 7702 plan. For many of you, sadly enough, you haven't talked to the advisor that sold you that 7702 plan in years. And that's a sad story because it happens quite a bit in the insurance business. So what should be the next step for you? The next steps for you should be either give me a call or an email to schedule a strategy session. If you already have one, I'll do a complete audit at no cost to you or obligation on your existing plan. If you don't have one, and you want to entertain the ability of putting one together for you and for your family, then we can discuss what it is that you want to do and the features and benefits that you're looking for, and then I'll design it for you. I'm an independent retirement strategist, so I have access to the major companies out in the marketplace. So I'm not married to any one company. I am actually married to my clients. And then obviously we would need to, once we figure that out, then we need to determine if you would qualify for a 7702 plan. Yes, there are qualifications that are needed for you to embark on a 7702 plan. And then I would determine what the product suitability and the plan structure would be, and I will do that together with you. So for those of you that may want to reach out and pick my brains and either have me do an audit or have a discussion regarding the benefits of putting a 7702 plan as part of your retirement strategy, please feel free to call me. You can call me at area code 786-766-1042, or you can send me an email at Bert, B-E-R-T, BertSalazar.com, BertSalazar.com. And always remember that my goal for you and for your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thank you for giving me a few minutes of your time, and I'll talk to you again soon. Take care. Bye-bye.